Every day, billions of dollars move through the stock market in milliseconds, executed not by humans, but by algorithms and automated systems. From high-frequency trading firms to AI-driven investment platforms, technology is increasingly calling the shots, making decisions faster than any human could react. Orders are placed, adjusted, and executed in the blink of an eye, often without a single person involved. This rapid automation raises an urgent question. Are we approaching a future where human traders are nearly obsolete and the market is entirely run by machines? Step inside the world of automated finance and explore what this shift means for investors, volatility, and the very structure of the markets we rely on. The stock market is evolving at a pace few could have imagined, with automation and technology increasingly shaping how trades are executed. From high-frequency trading firms to AI-powered investment platforms, algorithms now dominate vast portions of daily market activity. These systems can process enormous volumes of data, detect patterns, and execute trades in milliseconds, far faster than any human could respond. As a result, traditional human traders are finding themselves competing in an environment dominated by speed, precision, and automation. This shift raises critical questions about the future of investing. Will human decision-making become secondary to algorithmic processes? How does automation affect market stability, fairness, and liquidity? In this article, we explore the rise of automated trading, the technologies driving it, and the potential implications for the stock market. By examining the extent and impact of automation, readers can better understand how the markets are changing and what it means for both institutional and retail investors. Automated trading has transformed financial markets over the past 2 decades, moving from simple, programmatic orders to highly sophisticated algorithmic systems. Initially, computers were used to execute trades more efficiently, reducing human error and speeding up the process. Today, automation dominates large segments of market activity, from high-frequency trading in equities and futures to AI-driven strategies in Forex and options. The rise of automated trading has been fueled by advances in computing power, data availability, and network speed. Modern algorithms can analyze enormous datasets in real time, identify patterns, and execute trades within milliseconds. This capability allows firms to capitalize on tiny market inefficiencies that would be impossible for human traders to exploit. Even retail investors now have access to automated tools, from robo-advisors that manage portfolios to algorithmic trading apps that implement pre-programmed strategies. While automation increases efficiency, speed, and liquidity, it also changes market dynamics. Algorithms can react instantly to market events, amplifying volatility or triggering sudden price swings. Understanding the rise of automated trading is essential to grasp the technological forces shaping today's financial markets and the challenges this evolution presents for both human and institutional participants.
In today's stock market, human traders are increasingly spectators rather than active participants. While retail investors still place individual orders through brokers, a large portion of daily trading volume is executed automatically by algorithms and automated systems. High-frequency trading firms, hedge funds, and institutional investors rely on programs that scan multiple markets simultaneously, detect fleeting price discrepancies, and execute trades in microseconds. In many cases, a human never touches the transaction. Even mutual funds and robo-advisors contribute to automation. Pre-programmed rules govern portfolio rebalancing, risk management, and order execution, meaning trades happen according to algorithms rather than discretionary human judgment. The growth of AI and machine learning further extends this trend, enabling systems to adapt to changing market conditions and optimize strategies without manual input. This shift has significant implications. Human intuition, experience, and emotional decision-making are increasingly secondary in markets dominated by speed and technology. While automation improves efficiency and liquidity, it also raises questions about fairness, systemic risk, and market transparency. Understanding who or what is really placing trades is critical for anyone navigating today's increasingly automated financial landscape.
Artificial intelligence and algorithmic trading have reshaped control in today's financial markets. Algorithms no longer simply execute pre-programmed orders, they now make decisions, analyze patterns, and adjust strategies in real time. AI systems can process enormous volumes of market data, news, and social sentiment, generating trades with precision and speed far beyond human capability. In effect, much of the market's behavior is increasingly dictated by machines rather than human judgment. This shift raises questions about who really controls the market. Institutional firms with advanced algorithms hold a disproportionate advantage, leveraging speed, predictive models, and machine learning to anticipate market movements before humans can react. Retail traders, by contrast, are often responding to signals already influenced or triggered by automated systems. Even regulatory mechanisms must adapt, as markets now react in milliseconds, leaving little room for traditional oversight to intervene effectively. While AI and algorithmic control improve liquidity and efficiency, they also amplify risks. Flash crashes, rapid volatility, and unintended feedback loops illustrate how automated systems can dominate markets in unpredictable ways. Understanding AI's growing role is essential for investors seeking to navigate a landscape increasingly shaped by code and speed rather than human decision-making. As the stock market becomes increasingly automated, new risks emerge that are largely invisible to human participants. One of the most significant dangers is systemic vulnerability. Algorithms operate at extraordinary speed, reacting to market signals and other algorithms within microseconds. While this can improve efficiency, it also means errors can escalate rapidly, triggering sudden, large-scale volatility or even flash crashes. In 2010, for example, automated trading contributed to a market plunge that wiped out nearly $1 trillion in value within minutes. Another risk lies in homogenization of strategies. Many automated systems are designed to respond to similar signals or patterns. When multiple algorithms act in the same way simultaneously, it can amplify price swings, creating instability in otherwise stable markets. Machine-driven markets also reduce transparency. Retail investors and regulators may struggle to understand why prices move or trades occur, making risk assessment and oversight more difficult. Additionally, over-reliance on algorithms can foster complacency. Humans may assume systems are infallible, ignoring potential failures or market anomalies. Ultimately, while automation brings speed and liquidity, it also concentrates power, amplifies risk, and introduces vulnerabilities that were largely absent in human-driven markets, challenging both participants and regulators alike.
The rise of automation and AI in financial markets has sparked a critical question. Will human traders eventually become obsolete? In many segments, the answer appears increasingly plausible. High-frequency trading, algorithmic strategies, and AI-driven portfolio management operate at speeds and scales far beyond human capability. Machines can process massive datasets, detect patterns, and execute trades in microseconds, tasks that humans simply cannot match. However, humans are unlikely to disappear entirely. While machines excel at speed and efficiency, they lack judgment, intuition, and the ability to respond creatively to unforeseen events. Human oversight remains crucial for strategy development, risk management, and ethical decision-making.
Traders, analysts, and regulators still play a vital role in monitoring algorithms, interpreting market conditions, and intervening when automation fails or behaves unpredictably. The future may see humans shifting from direct trading to supervisory and strategic roles, guiding machines rather than executing trades themselves. Automation is redefining the skill set required to participate in markets. Speed and reaction are now algorithmic strengths, while critical thinking, oversight, and creativity remain distinctly human. In this evolving landscape, humans are less obsolete than indispensable, but in a very different capacity. The stock market is moving steadily toward automation, driven by algorithms, high-frequency trading, and AI-powered systems. Trades are increasingly executed by machines that can process massive data sets and react in microseconds, leaving human traders struggling to compete on speed and scale. Automation has improved efficiency, liquidity, and market access, but it also introduces significant risks, including flash crashes, amplified volatility, and reduced transparency. While machines dominate execution, humans remain essential for oversight, strategy, and judgment. Traders and regulators are shifting from hands-on trading to monitoring and guiding automated systems, ensuring that errors, unexpected events, or unethical practices are managed responsibly. The future of the market is not entirely human-free, but it is increasingly machine-driven. Understanding this shift is crucial for investors, professionals, and regulators alike. Automation changes not just how trades occur, but how markets function, the role of participants, and the skills required to succeed in a rapidly evolving financial ecosystem.